My name is Griffin Anderson. I work at Consensys driving a project called Balance, where we're basically re-engineering accounting systems and enterprise resource planning systems using blockchain technology and digital currencies and rethinking that whole process using the new technology. In addition, I work primarily with the large accounting firms across audit, tax, and advisory and looking at how this technology is going to disrupt their lines of businesses as well. So that's what I do a little bit at Consensys.
Thank you. Andrew, you want to go ahead?
So for those of you who don't know me, my name is Satoshi Nakamoto. My name is Andrew Keys. Helped grow Consensys from about 300 people to 700. It's the largest software engineering shop in the world focused specifically on blockchain technologies. Prior to that, I worked at a hedge fund owned by Goldman Sachs and at UBS.
Brian, you want to go ahead?
Sure. Can everyone hear me? I'm Brian Steele. I'm responsible for market solutions at Goldman Sachs. And so within the team, we're really responsible for a couple different disciplines, one of which is around sort of disruptive technologies more generally. So of course, blockchain, AI, machine learning, et cetera. And then sort of fintech in general. So where fintech is sort of disrupting the market more generally and disrupting finance, we look at and evaluate technology companies that provide sort of a differentiating value largely for our operations sector of the firm.
Hi, everybody. My name is Danny Aranda. I'm at a company called Ripple. We're a blockchain company. We're focused on payments. Our vision is that there will be an internet of value where money can flow as easily and as cheaply as information does today. So while this panel has already been happening over the past couple of minutes, my phone has probably sent out 1 million packets of information, and we want money to flow in the exact same way. My own personal role at the company, apart from speaking on panels with Andrew Keys every other week, I focus on partnerships. Ripple, I've been with the company since a couple of months after it started, helped build the business development and the sales teams.
That's great. Thank you. Brian, can you please start off with sharing how traditional finance institutions such as Goldman Sachs see blockchain as a solution?
Sure, happy to. So, certainly I attend, in the context of my role, I attend a lot of industry forums and conferences, and I think, blockchain distributed ledger is always a topic of conversation, sort of at every one of these events. So there's certainly a buzz around blockchain distributed ledger, and frankly has been for probably at least the last 2 years, if not longer. I think as it relates to how Goldman Sachs sees blockchain distributed ledger, we take a very measured approach in terms of how blockchain or distributed ledger certainly will transform our businesses. We really look at blockchain distributed ledger across the lines of private permissioned ledgers, as opposed to obviously what probably the majority of this room realizes is Bitcoin and being much more of a public blockchain. We also look at sort of DLT and smart contracts in conjunction with one another and the value that brings to disrupting many of the functions and processes that we operate at the firm. We look at, we really evaluate the technology from a couple of different dimensions. One of which is, does it solve a business problem? Is it addressing a business problem, or is it sort of classically the sort of hammer looking for a nail? I think we obviously take a approach where it needs to be sort of a differentiating technology, which I think we certainly see across the sector today. But we want to make sure that it's bringing value and it can be applied to the business problems that we have within the firm, and that sort of really are faced by not only us but certainly our clients at the same time. The other thing I'll mention is, we see certainly blockchain distributed ledger playing a part in really the role that traditional market infrastructure providers play today. And so where you see a case where it's a securities depository or it's a clearinghouse, really playing a key role, providing that stability and really reducing a lot of the credit risks that exist in the market today. Surprisingly, there's a lot of asset classes that are part of the financial services industry that don't have that traditional market infrastructure and really still operate in a very bilateral capacity. And I think we certainly see distributed ledger or blockchain providing value and really filling the gaps where market infrastructure providers don't play a key role for us today.
Thank you. So Andrew, having worked with both incumbents and now with disruptors, would you like to add something here?
Sure. So I would say one piece that I would add is that finance and banking is the tip of the iceberg, or just one vertical in a horizontal upgrade of our world's database and internet systems. I believe here in 2018, we're in the equivalent of 1994 to the 1996 internet in kind of the evolution of our next generation of the internet. And I think we have to kind of zoom the lens back or widen the vantage point. And a lot of the narratives around speculating on a price of a specific token, when we really need to understand what the next generation of the internet will look like and what those implications are. So to simplify it, I think there are three core tenets that people need to take away. The first is the notion of self-sovereign identity. It was briefly touched earlier. The notion of rather having our information captive to a certain extent in a intermediaries database. We're going to have a mobility where we'll be in control of our canonical identity, and we'll be able to attach attributes or attestations, so facts or opinions about ourselves, and we'll be able to recant that information. Like if you had an electronic medical record that went to a doctor, and you'd be able to take that back if you changed doctors, for example. The next is the notion of the tokenization of all assets. We have the ability to tokenize fiat currencies, securities, commodities, Beyonce concert tickets, any type of asset, software licenses. And what this will do from a macro perspective, in my opinion, is going to create the thawing of liquidity unlike anything planet Earth has ever seen. So if the 200 of us in the room owned a building through a REIT, there's friction involved if we didn't have it in a REIT, actually. There's friction involved if one of the 200 of us wanted to essentially sell our shares to the other 199. With the tokenization of a parcel of land, you'd be able to move that ownership without as much friction and create secondary and tertiary markets and you can remove land and or a building and turn that into rainforest, or turn that into solar energy. You can have an electron that comes from the sun that hits a solar panel. You can actually tokenize that energy. And that's going to thaw liquidity. And the last core tenet is the notion of smart contracts, which are neither smart nor contracts, but it's the way to automate our agreements. So we've been growing up on Microsoft Word documents drafted by attorneys, notarized, that if there's a breach in those contracts, the assets that are mentioned in the contracts may be hard to encumber, may be hard to stop. But now with the ability to have digital assets and literally our agreements turning into software, you're going to have much more fluid agreements. So basically what this technology is doing is commoditizing the way we trust each other and the way we agree with each other in the context that the internet commoditized how we communicate.
Okay, great. Thank you. So coming back to the pure disruptor point of view, we saw a few major banks coming out with recent SEC filings citing that they face both competitive and compliance risk from cryptos. So from Ripple point of view, Danny, would you like to add what kind of, let's say, competitive risk is there or value add you can put to banks, let's say SWIFT system we were talking about, Dean talked about SWIFT. How do you see that Ripple can add value or sometimes can become a competitor?
Yeah, I think to maybe lift from a lot of the internet analogies that are in the space for blockchain technology. So if you look at the early days of the internet, you look at an ad from someone like CompuServe, it would actually say things like, come to CompuServe to get access to the most users, the most number of websites, the most chat rooms. It was essentially advertising reach, that you got access to more of the internet through CompuServe. And if you're going to go out and buy whatever Verizon Fios is the internet service provider use, that would be a ridiculous idea. the idea that I would get kind of more of the internet through Verizon. Really, it's a bit of a commodity service now. They're advertising cost, speed, and reliability, but it's all to access the same thing, the same internet. And that concept of reach has been totally commoditized. When we're very focused on payments, we think payments are very strategic to the way financial services are rendered. So like most financial products are actually executed through a payment. So a very basic one is lending. You don't actually get the loan until a payment goes from my account into your account, and that's when you actually receive the loan. People also think payments are very central to actually the internet. So a lot of internet services, marketplaces, Uber, Airbnb, payments is a huge part of their operation. It's one of the biggest engineering teams at Uber just works on payments. And so we think payments is kind of in a similar place to where maybe the internet was back then. So if you look at Visa, their tagline, their motto is Visa's everywhere you want to be, and for everything else, there's MasterCard. This idea of reach still really plays into payments. So this idea of competition for traditional financial institutions or traditional intermediaries, we think that's real. I mean, I think where a lot of this technology goes is to commoditize a lot of this reach and access to different networks. But I think it's also an opportunity, and that's what we talk to a lot of the banks that we work with about. What we talk to them about is, hey, this will solve a problem for your customer, and you're going to be able to serve them in a better way, which will increase your top line and your bottom line. And I think that's the wedge of how you get these technologies out into the market, is just thinking about an initial customer, how you can solve their problems, and that'll help these things proliferate over time.
So yeah, it's great that you mentioned Visa and Paytm in India as well, PayPal. So if I talk about Ripple solution just for our audience, would you want to differentiate? So these earlier fintech solutions have already been there. What's the value add which Ripple adds in their existing presence? So what's the value add?
Yeah, take a business like Paytm. Paytm is a wallet service in India. I think it's the largest wallet service in India now. They are essentially providing accounts to users, and they're providing a really easy way to pay. The way you can think of Ripple is, for a network like Paytm, it's just the connective tissue to other networks. So if you're starting out at a bank account at Bank of America in the US, you would be able to send over to via Ripple into any Paytm account. We're really just trying to connect different networks. And I think our main thesis, our kind of reason for being, is that the use cases are really changing, and customer demands are really changing. So a lot of the payment systems we have today were built for 1970s use cases. It was like Shell, at the end of the day, would push out a file to their bank and move around $50 million at the end of the day. Now it's like, hey, $2 needs to go from a bank account in San Francisco to the mobile phone account of a driver on the Uber service in India, and they're on a Paytm wallet, they're not on a traditional bank account. And Swift, these kind of ACH, these different systems weren't built to address that use case. And even if my own kind of very pedestrian basic needs as a consumer are that I want to send money, but when my expectations in terms of a product experience are that I send an email and you receive it immediately, or I send you a text and you receive it immediately. But if I send money, it takes 2 to 3 days. There's a disconnect. And so our argument to a lot of the folks that we work with is like, hey, you need new infrastructure because customer demands are changing.
Okay. So coming back to the most interesting part of the finance, accounting. Combine it with blockchain and you have blockchain-based accounting. And if that wasn't exciting enough, you make it super interesting by calling it triple entry accounting. So can you please explain triple entry accounting for us?
So we're here to kind of reinvent how accounting information systems have been done. Really, there hasn't been much innovation in the last 700 years. We moved it to the mainframe, to cloud, and that kind of changed the way we distributed the information and stored it. But for the very first time, blockchain technology allows us to basically share data and share our infrastructure. So historically, companies all around the globe run and operate their own accounting systems, their own ERP systems, and oftentimes those systems don't talk to each other. So what we're doing at Consensys on the Balance team is we're re-engineering those systems to be built on top of the blockchain technology and DLT technology, and basically rebuilding the business processes from scratch using smart contracts and other infrastructure. And if we do that, if we kind of share the information on chain, what happens is we can prevent a lot of the fraud at the transactional level that often happens and mistakes that often happen. So the bookkeeper won't make a mistake entering the information into their accounting system. The system isn't operated and controlled necessarily by the entity themselves, which then therefore causes possibly the option of fraud and other kinds of mistakes. And there's a lot of cost and compliance done with running these systems by yourself because you have to call in auditors who test materiality of the transactions and so forth. So what triple entry accounting says, it's not like double entry accounting where that's a reference to debits and credits. Triple entry accounting really says, can we kind of come in and re-engineer how we're storing the information between these companies? Can we come together, take two companies that are entering into a financial transaction or a company and individual, have them come together, sign a digital handshake, a digital receipt, and store that information on the blockchain? And if we do that, what we can do then is we have the provenance of the actual record, and from there we can basically roll up each entity's perspective on the information. So triple entry kind of came from the idea that the information originally would be recorded on the blockchain in both each individual's accounting systems. But as we're kind of moving forward, what we're doing is we're just re-engineering all those systems to run on top of blockchain and DLT technology. And if we do that, we drive up what we call each entity's trading partner's perspective on that information. So a quick example so everybody here in the audience understands what I'm talking about. If we had two companies that entered into a financial transaction and one, let's say, purchased a cup of coffee from another company, what we're doing on chain is we're swapping the underlying assets. We're swapping the cup of coffee for some, in this case, maybe tokenized dollars. And then what we do is we drive up each entity's perspective. So from that, the company that was entering and purchasing the cup of coffee basically made a purchase, and the company who's selling the cup of coffee basically made a sale. And we drive that information and roll it all the way up to the financial statements and other types of reporting and compliance views as well. And so what we're really doing is re-engineering how we share information in our business processes. When we start to think of it like that, the old things that we used to do, send purchase orders and sales orders and invoices and so forth, is kind of something of the historic, of the relic of the past. What we're really doing is re-engineering those business processes to all run in smart contracts and basically keep track of the states between entities all on chain. So this is one of the use cases that's pretty promising in the blockchain space.
Thank you. So you were talking something about frauds and everything. So if there is an objective entry, then definitely that's good. But how do you take care of, let's say, subjective entries where all these frauds happen? Where should that entry go? In that case, blockchain cannot, or maybe you can clarify this thing. Will blockchain help us in those subjective decisions where to put that entry, or some other issues, let's say privacy, how much data you want to make it public, how much to keep it private? Would you want to address those concerns?
So our software is focused right now on serving the crypto companies. So if you're a token sale or an ICO, or you're going to issue a securities-based token, you're probably going to need our software to basically run and operate your books in. So that's kind of where we first started. Privacy is an interesting solution. What we're seeing in the public protocols is we're just probably a couple of years away from privacy being built into the protocol level, and the private permission context is less of an issue right now. And so what we're really doing is we're saying, okay, we're just going to start at the very foundational level, keeping track of the transactions, and we're going to let all the stakeholders that need that information, allow them to drive up their interpretation of the underlying information. So we're working with a lot of the regulators and so forth to create ideas and such as multi-sided financial statements. So why do we have to pick subjective measures? Why do we have to pick a specific inventory method? Why do we have to pick a specific valuation for an underlying asset? Why don't we just give the core amount of piece of information and allow entities that have a stake in that underlying information drive up their perspective? Global companies might be a little nervous right now to start doing this and opening up their financial books and so forth. But what we're really seeing is a lot of traction from a lot of the companies operating in the blockchain space, because oftentimes these companies are basically issuing token sales from day one. They believe in transparency. A lot of their information and data is already public. And so that's really where we're getting our foothold in right now is companies that have started on day one operating in crypto, which is kind of interesting.
Thank you. So coming back to Brian, when we look at the landscape for banks specifically, we have seen differing strategies. Some have invested in blockchain startups, companies, others have tied up with R3, Ripple, and other blockchain-based companies. How do you see investment in blockchain from incumbents' point of view?
Yeah, and I think, as I kind of mentioned, just building on what I mentioned earlier in terms of Goldman Sachs taking a bit more of a measured approach. We're not a member of R3, we're not a member of Hyperledger, we're not a member of Enterprise and Ethereum Alliance, but we have multiple parts of the firm evaluating different blockchain and distributed ledger technologies from different points of view. We have a principal strategic investments group that looks at it through the investment lens, where should we be making hard dollar capital investments in different blockchain firms. We have a group in technology and research and development that are evaluating the technical components of distributed ledger and blockchain technologies as it applies to business problems within the firm. And then you have my group in market solutions that's really looking at it from a business application point of view as to where can we evaluate, where can we identify a business problem and then identify where in the market this is being solved through existing technologies, or in some cases it's not, and it creates an opportunity for us to sort of engage the industry more broadly to solve a particular business problem. It's public. One of the opportunities that we're looking at right now is really focused around equity synthetics, and that is again on the theme of what I talked about earlier, where for uncleared swaps in general, not just equity synthetics, there isn't a market infrastructure, a key market infrastructure that exists today to take out a lot of the risk and reduce a lot of the cost. And so banks in the market today are operating. Not even banks, buy-side firms and sell-side firms are operating in a very siloed mode, and each phase in the life cycle of a swap is processed independently. And so there are, of course, then reconciliations that exist at a point of confirmation, at a point of a life cycle event that has occurred, at a point of a payment that has gone out the door. And so we're certainly encouraged by what blockchain can bring through blockchain in smart contracts in particular, what that can bring for disruption and sort of what I consider to be operational alpha in sort of the OTC derivative space more generally, and where market infrastructure providers are not sort of filling the gap. I think the other thing I'll mention is I think what we have largely seen as it relates to sort of the trend in blockchain and distributed ledger, it's, as I said, there's sort of a palpable buzz in the industry on this particular topic, and it's not always the only solution, right? Certainly, I mean, we evaluate it from the standpoint of could we solve it through traditional databases as much as we do through can we use this as a bit of a differentiating technology, and what I found is it actually, irrespective of whether it is differentiating or not, it's bringing the industry together. So it's bringing, it's causing the need for us, certainly in pockets, to solve business problems, which didn't exist before. So if it's used as a marketing ploy, for lack of a better term, or a means by which we can gain resources within the firm, people to focus on the attention that's needed to solve the business problem, like creating standardized data models and using the same reference data or building golden source reference data. I mean, some of those are really foundational components to operating a distributed ledger. You can't just sort of wrap a Band-Aid around it and call it distributed ledger and it's going to solve a problem in the industry. So certainly encouraged by the direction that it's going and where it's being applied.
So that's good. So you mentioned about private permission blockchain, and Andrew, you were mentioning you were doing sort of analogy here in blockchain space with internet.
Sure.
So what's your take on, during internet, we said that main innovation came from the public internet, not from intranet.
Sure.
So what do you see happening here in comparison to private permission versus public blockchains?
So, I mean, I don't necessarily think that it's completely fair to say that the major evolution was solely from the public internet. The intranet was first, so it was foundational to creating the internet. TCP/IP, HTTP, these were foundational elements that were built on above intranets initially. So, and things like SWIFT that move the majority of Earth's money today are all permissioned intranets. I think there will still be use cases, especially in regulated industries. And there will definitely be the majority of use cases until the public permissionless blockchains scale. So right now, I believe that we're in 94 of 96. The holy grail, if you will, of public blockchains are scalability and privacy. The one that I believe to be the strongest, that Consensys does the majority of their work on, and the most expressive, is one called Ethereum. It has 4 scalability upgrades that will be happening over the next 24 months. The first is the notion of state channels. So if I took everyone to a restaurant and gave the bartender my credit card, and I opened the tab, and I bought everyone a Shirley Temple, that would be a batch transaction. And I bought everyone an appetizer, everybody lunch, and everyone dessert. Each of those transactions could essentially stay on that tab until I close the transaction. So basically opening the transaction and closing the transaction can be on-chain, and then you can batch thousands of microtransactions off-chain. The next is transitioning from what's called proof of work, where you have GPUs, NVIDIA, AMD cards. That's what basically the Bitcoin blockchain and the current Ethereum instantiation is mining. It's transitioning from proof of work to what's called proof of stake, where you have essentially a energy efficient implementation where you basically make deposits and solve the same types of math problems. Next is what's called sharding, where you have shards of the database having to form consensus instead of the entire database forming consensus and coming to agreement on the state. And then lastly is a technology that was created by a gentleman by the name of Joseph Poon, who created the Lightning Network for Bitcoin, which is basically Bitcoin's state channels, called Plasma, where you essentially can have a settlement finality layer of a public blockchain and then have blockchains on top of that. And they can interoperate with public and private instantiations. Another piece to note is that I think 2018 will be the year of interoperability. We've seen relay mechanisms where you can have a digital token taken from a permission blockchain and then essentially destroyed or a receipt of that destruction, and then it's used on a public blockchain. The Monetary Authority of Singapore, Consensys, and JP Morgan essentially did that with real-time gross settlement of fiat. So basically you had 11 institutional banks that were able to net dollars, and it originated from Santander that it would take 2 days to move money from Portugal to Spain, and it was faster to drive it there instead of and then basically they were able to do the real-time gross settlement of fiat in 10 seconds.
Okay, that's great. So now let's shift some gears and come back to some of the key challenges we are facing in blockchain adoption in financial services. So there was a recent article in Reuters where they mentioned that some of the projects in financial services are kind of failing, DTCC and other projects they were mentioning. So coming back to the specific concerns in blockchain-based fintech solutions, so Danny, you would want to address that there is a concern that we don't really need XRP to use Ripple. Do you want to address that question?
Sure. So just to kind of give the question context, people analyze blockchain projects today and say, like, hey, do you really need a token to do this? And like, what is the usefulness of that token? And it's a really good question because there's a lot of speculation around what the values of these tokens should be. And so understanding its real underlying utility is important. Ripple's use case within the context of its cross-border payment solution for XRP as a digital asset is for liquidity around global payments. And it's actually optional to use within the Ripple kind of payment ecosystem. And the reason why that is there was reference to a project called Lightning, which is essentially a layer 2 scaling solution. We invented a protocol called Interledger. It is also a layer 2 solution. It began with the premise of interoperability between ledger systems, whether they're blockchain-based or they could even be centralized ledgers like a bank's core ledger. So when we are integrating things into a bank to bring them onto a new network, we're actually making their core ledger compliant with the Interledger protocol. And through that protocol, they can route through any kind of ledger system they want. So they could move from their bank's ledger through the Visa network, through the SWIFT network, through any kind of interledger compliant network. One of those ledgers they could choose to move through could be blockchain-based ledgers, so like Ethereum or Bitcoin or XRP. And we want to position XRP to really compete. So this is about creating like a very open standard, just like a web of different ledger systems, and that XRP will have to stand on its own 2 feet and compete for serving that liquidity use case.
Thank you. So coming back to Griffin, accounting-based solution. So there is a quote
Fun sponge.
for banks or traditional institution that if it ain't broken, don't fix it. So do you really think that these accounting solution, you can argue that, okay, fine, they are broken and we need to fix them, but as of now, they don't have that much of a large incentive to move on to blockchain-based accounting solution directly. So how do you address that challenge when you reach out to those big companies through your accounting-based coalition and other initiatives?
So let me ask the audience a question here. How many people own digital currencies right now? Just at least a portion of it. So pretty much most of the audience right now. So the way we're kind of looking at how this is going to work, and at least our perspective is right now, all the assets you own, probably just a small percentage of that right now is digital currencies, or some form of token or digital asset right now. Could be 1%, could be 0.5%. But our bet basically is as digital currencies begin to proliferate, as these assets on these ledgers that are open continue to proliferate, the number of assets you own and maintain are also going to increase digitally. We're sitting in a position right now to basically provide the general ledger and the financial statements for those digital currencies. Just like the major Fortune 500 companies that are beginning to accept digital currencies as a form of payment, they have to use us right now as a crypto subledger. The assumption is over the next 5-10 years, these digital currencies are going to proliferate, and the percentage of the asset classes that these entities begin to hold is going to increase. So it's going to go from 0.5% to 1% to 10% to 20%. And eventually, I think it's going to cross the threshold where these entities then move to more of a crypto blockchain type ledger system. So that's how we're approaching the space, is we want to be this crypto subledger for you temporarily. And then as your digital assets begin to increase and your portfolio begins to increase, we'll be here to kind of serve the market. So that's how we're thinking about it.
Could I add just a?
Yeah.
So I'm a simpler person than Griffin. He's very intelligent. If Alice gives Bob $1, there's the credit for the dollar in Bob's account. There's the debit in Alice's. Right now, Bob can change that dollar to $1.50. Alice can change the dollar to 99 cents. It could be an error. It could be disingenuous. And that's how planet Earth's accounting systems are working. This was created by a monk in the 1600s.
In Venice,
right. So this was double entry accounting was created by a monk in the 1600s. And so now when Alice gives Bob the dollar, there's the credit in Alice's book, there's the debit, but now there's this third ledger entry that's immutable. It's the watermark. It's the recognition that we can never change that. That's the agreement. And basically, we can't change the dollar to $1.50 or 99 cents. And what you just did was automate audit. Deloitte, PwC, KPMG, Ernst & Young, they get paid billions of dollars to reconcile. When did I send you the invoice? When did you pay me the dollar? And if you can basically automate that, that has profound impacts for how our financial systems work. So while it's boring and we make fun of Griffin, this is foundational and systemic to the way planet Earth will work.
We're colleagues, by the way, so it's okay.
I'm not allowed to make fun of Griffin.
You can, it's okay.
So let's make it more interesting. Let's add smart contracts to it.
Yeah. So once again, what we're doing is taking that business logic, that purchase order, invoice, sales order, and we're just re-engineering that with smart contracts and deploying that on chain. So when two entities do that financial transaction. They send a dollar to somebody else and receive a widget. That's just going to be happening in smart contracts. It's going to be behind the scenes. The user experience, what you log into your computer and you see on the browser, is all going to be pretty much, for the most part, very similar. It's everything behind the scenes that's changing with the infrastructure. And the way we do that is we just code up these transactional interactions in these smart contracts and deploy them on chain. So that's how it kind of works.
Great. So we were discussing it with Amber all day. She was like, it's very hard to even create a Slack channel for coordination in major banks. Leave aside creating an open source software in regulated industry. So Brian, would you want to address some of the key challenges that you've faced in blockchain adoption in your organization?
Yeah, absolutely. I think, and it's probably not, limited to my organization as it relates to sort of blockchain adoption more generally in the industry. I think I talked about before. It's in terms of the data being foundational to a blockchain, right? It's the classic garbage in, garbage out. So to the extent that you're not using common reference data sources or haven't identified a common reference data source, to the extent that you don't have a standardized data model or trade terms that can be used on chain, to the extent that you don't have a consortium, right, a key sort of network effect that exists across like-minded firms that, oh, by the way, need to relatively move at the same pace, right, in terms of adopting the technology. I think, it certainly shouldn't be news to anyone. I think it's sort of pervasive across the industry, and I'm sure that's what Amber was highlighting before, as it relates to there is legacy infrastructure that exists at every bank across the street, and certainly, many, many buy-side firms in the same capacity. And so, while blockchain is absolutely disruptive, and distributed ledger is certainly absolutely disruptive, there needs to be sort of a mass adoption. Firms need to make the right capital investment to be able to adopt the technology. And there needs to be sort of a consortium, a network effect of like-minded firms that adopt the technology and sort of take that forward. There's a lot of foundational questions that need to be answered as part of solving a lot of the business problems that exist in the market today that, as I said before, I'm encouraged by the fact that there are groups in many pockets of the industry that are trying to solve those particular business problems. And we may find in solving the business problem, blockchain or distributed ledger technology, sort of at the end of those foundational pieces that we're solving for, is actually not the most efficient way for us to operate and solve that particular business problem. So I'm encouraged we're solving the foundational pieces, and then sort of the end deployment of the technology that builds the network. It may or may not be distributed ledger.
So I'd just touch on that. So I agree for a bank, which in many instances provides trust and intermediation, because essentially that also commoditizes their worth. So I think that you're also going to have to re-architect the thought processes of what financial services is. Liquidity pools, financial advice, but banks are also going to have to be forced to move up the stack, because the 10-year-olds, they're using Venmo. The 15-year-olds may not have bank accounts, and but they will still need a car loan. They still will need, the capital markets will still need OTC trading. But I think that there's also a conversation of what is this technology commoditizing? And then what does banking look like in 20 years?
Great. So if I'm not wrong, I was listening to Brad. He said we are signing one bank a week. If that number is, if I'm not wrong here. So, but I'm sure you must have faced some challenges while partnering with banks. Do you want to mention some of the challenges, if at all?
Sure. So I've been with Ripple since mid-2013. I remember being at the first time we were in front of a bank, and they were just like, "What the hell are you talking about?" Because we were talking about open networks and open source, and it just wasn't making any sense. I think the number one piece of advice I can give for anybody who is selling really to anyone is just to identify a problem that they have. And so I think if you look at the banking space very broadly over the past 10 years, there have been a couple of shifts that have happened. So obviously the financial crisis, I think there were a few years where banks were just focused on remaining solvent out of that. Then there was an entirely new compliance and regulatory regime that came in, so they had to invest in to make sure they were compliant with that and aligned with it. And I don't think it was until about 4 or 5 years ago that the shareholders of banks began to ask, like, hey, where's the return on our equity? And a lot of that return, the answer is it has to come from growth. Also, there were kind of new limits on a bank's balance sheet, things like Basel III and new regulations that came into place that made it less able for banks to be able to go and purchase other banks, right? So you have, I don't know, so Santander grew for a long time through acquisition. And so I think a lot of the answer, and Santander's chairwoman talks about this a lot, is like it's going to come from innovation, from new products, like new services that you can offer into the market that is going to please your existing customers, help you gain new customers, kind of bring you into new markets. And that's kind of a classic business thing, like how do you grow a business? And I think that's a lot of what we try to speak to. And the best way that we found to do that is to focus on one problem, which is payments, and just kind of be the best in the world at that problem in order to make sure that we're able to kind of find that initial wedge to get market traction.
Thank you. So where do we go from here? Could you share your views about what's going to be real in 1 year, Brian? I know it's tough to predict 1 year, especially in blockchain, when 1 year in blockchain is like a decade.
Yeah. No, I think I'm happy to. So I think we're still very early on in my mind as it relates to sort of the, in the maturation cycle. As I mentioned, some of the challenges in terms of preventing the technology to be a bit more pervasive. I think where we are seeing the implementation of distributed ledgers in the industry, certainly from my vantage point, and things moving from a classic sort of POC, we've tested the technology, we know it works for this particular use case. As a bit of a sidebar, I was listening to some at a fintech conference most recently, and they sort of said, well, look, we've deployed distributed ledger technology for stock loan transactions, but there were 13 legal agreements that we needed to sign to actually get to that point in time. So we're very early in the maturation cycle. I think where we are seeing it deployed into a very much of a production environment is with market infrastructure providers. It was funny because I read that article, of course, as well, in terms of it mentioning DTCC passing on the opportunity to deploy distributed ledger technology. But in other parts of their business, they are deploying distributed ledger technology for credit default swaps. So it's easier for market infrastructure providers to disrupt themselves, right, to implement new infrastructure through distributed ledger technology, because they can host the node on their behalf for the participants. So they don't need to have everybody move at the same phase of the maturation cycle, and technology doesn't need to move at the same phase, and it's certainly not going to for the number of participants that exist at market infrastructure providers today. Obviously, ASX is probably the most notable deployment, and DTCC is another, and CLS is another. So there's many different deployments that will happen over the course of the next couple of years. I think equal parts to that, you'll see where distributed ledger technology is being deployed in very targeted areas where it makes a tremendous amount of business sense. Like I mentioned, OTC derivatives and uncleared swaps. Syndicated loans is a very archaic sort of post-trade processing that occurs in the industry, to the extent that it takes many, many days for us to settle loans in the industry. Physical commodities is another area where you could certainly see, along the lines of very much where distributed ledger technology is being deployed in supply chain, how physical commodities inventory management could be certainly an area where that's being deployed as well. So clearly areas where there isn't robust market infrastructure, but it's only sort of later in the life cycle where those market infrastructure providers that are not disrupting themselves, you'll start to see distributed ledger technology really disrupting their business model. Like, is there a need for a clearinghouse that takes us out of the business of the 2 or 3 day credit risks that exist in bilateral, and very much in bilateral markets or bilateral trading between execution and settlement, if in fact you're able to settle the asset in a real-time environment and you're able to move money in very much of a real-time fashion. So sort of early days, but certainly very much encouraged.
Okay, Danny, in the interest of time, you want to add some some points on it? How do we go from here? How do we go from here, let's say 1 year down the line?
The
1 year down the
future
line.
in general. I mean, I'm really curious. You know, when we started Ripple, there wasn't much of like a crypto ecosystem, and we were looking for ways to get traction, which is why we looked at, hey, the initial wedge could be around bringing traditional financial institutions on board, so that some of these traditional flows, these payment flows, now come over crypto as well. But now there is kind of an ecosystem emerging, and there are like lots of very big companies like Consensys and different folks in the sphere. We've been looking at a lot of just kind of crypto to crypto use cases. So like imagine a world where you open up your phone, you open up an application, and that application is actually using various decentralized resources on the back end in order to render that user experience. So it's using Filecoin for storage, or Golem for computing, and a bunch of other things in order to allow for that application to exist. All those different components are going to require that there's some kind of movement of value, because maybe the user's wallet on their phone is on the Lightning Network and it's denominated in Bitcoin. Maybe that user's phone is actually, it's an Airtel wallet, like denominated in rupees in India. And so we're curious about how value movement will change and exist in kind of these new ecosystems as well, and how that'll kind of bridge with traditional financial institutions as well, as more people kind of come on board.
So we are running short of time, but last question to Andrew. So many of us are here today are aspiring entrepreneurs or people looking to get actively involved in the space. Would you want to quickly mention some use cases where people can start thinking about related to blockchain?
Before use cases, I think it's to go build something, whether it's building a business or building software. It's not going to happen without your own initiative. This has created almost a Cambrian explosion of entrepreneurship and a re-articulation of how our financial, social, political operating systems work. And we're in the first out of the first inning. You're in the perfect timing, Wharton grads. If you need a job, come to me. Go build something.
I'm hiring too.
Yeah. He's got 10 openings.
Engineers, marketers, anybody.
We are hiring as well.
Thank you.
This is a
Ripple, you guys
we're open for
Ripple's
business.
hiring.
Great. Okay. Now let's open the floor for some question and answers. Yeah, please go ahead. David.
A lot of the discussion has kind of segregated discussion around distributed ledger technology from cryptocurrencies and tokens. I'm just curious to hear your views on that. Intertwined and required to incentivize, or should you have distributed ledger technology without cryptocurrencies as we know them today?
So you can absolutely have distributed ledger technologies without cryptocurrencies. I'd also add that planet Earth is undergoing a bit of token fever. We've had a great evolution in 2017, whereby we essentially democratized venture capital on planet Earth, where instead of it being 10 white males in Sand Hill Road in a small part of Silicon Valley, you now are able to have the behavioral economic aspects of tokenizing software licenses, securities, et cetera, and have thousands of people now contribute to a crowdfund. That being said, there's a lot of regulatory catching up that has to happen. Some of those probably were unregistered securities. Consensys personally created what's called the Brooklyn Project, which is working with the ECB, the SEC, the CFTC, and incumbent technology companies and startups to define a topology for tokens. Some may be software licenses, some may be actual securities, and there are different regulatory frameworks that you have to abide by when determining which token you are using. But I think you would be missing kind of 1/3 of the magic of this new technology if you didn't recognize the fact that we can now natively digitize assets. And that being fiat, commodities, milk, anything, and with that, the efficiencies that you gain from being able to move these things peer-to-peer via an atomic swap rather than a T+2 settlement around the world immediately without friction.
Yeah, I would also add that I think they'll coexist for a while, but what's really interesting about public protocols is you have a token, an incentivization model built into it. And so what that does is, what you're seeing, if you look at kind of the very best engineers in the world, a lot of them are staying in their parents' basement, coding all night, that kind of thing. And they have an incentive to work on the public protocols because ultimately they most likely probably own a portion of the underlying utility token in this case. And if they continue to improve the protocol and make it better and better and better and build awesome use cases and applications on top of it, ultimately they have a personal incentive at stake to make the protocol better. And private permission protocols, one of the challenges is oftentimes, even though they might be open source, most of the communities are being basically maintained and developed by enterprises and large corporations where you're paying engineers to work on it versus kind of the freelance engineers working on it. So what we're seeing is probably a lot more innovation, at least from my perspective, happening in a lot of the open source and public protocols where there's a token or some sort of value incentivized around that.
I mean, just to maybe put a finer point on that from Ripple's perspective, we haven't seen a ton of value in these kind of private ledger systems. Like, we think they're actually kind of just more complicated databases, and that you should probably just use like an Oracle or an SAP database. Like, I think a lot of the innovation, a lot of the real value is coming out of this public, permissionless, open source world. It's where we spend all of our time, and it's also where you're seeing a lot of the market action. Like, I mean, some of these kind of private blockchain companies, I just don't hear a lot about them anymore in the market. I think, and that could just be kind of where we are in history right now, and kind of the up curve of kind of this new kind of tokenized landscape. But I think a lot of times we're very suspect of some of these kind of private blockchains because they essentially just look like normal databases, which I don't know if that's a fundamental innovation.
Sorry, we are running late, so maybe last question, yeah, please.
Yeah, I'd like to repeat the earlier question about XRP, but direct it at Brian. Specifically, it's clear that Ripple and other blockchains are useful for banks, but what about these so-called bridge currencies? And it's unclear whether banks like Goldman are actually going to use it as part of their treasury. Can you give a clear answer to that at this point?
Yeah, I mean, unfortunately, we're not in a position at this point to say, to talk a little bit about sort of, digital assets in cryptocurrency. So I can't, unfortunately, at this point.
I can address something around that. In any startup, you have to think about sequencing and timing and crawling, walking before you run. So a giant bank like Goldman Sachs or HSBC, who have literally like the need to move tens of billions of dollars a day, crypto markets are still very thin to use that for payments. So crypto markets today are somewhere between $10 billion to $20 billion a day is actually moving in and out of them in dollar kind of notional value. That's still small compared to the larger FX markets on the fiat side, which are about $5 trillion a day. And they've grown a lot over the past year, so it's not hard to imagine that within 5 to 10 years they're competing with those traditional markets. But where you start is with really low value payments. And that's why we're partnering with firms like Western Union, MoneyGram. These are companies that send their average transactions about $200. And that can totally be accommodated by the liquidity that's happening through Bitcoin, Ethereum, XRP, and that's where we're kind of starting. So I think you'll see kind of this gradually move over time towards these more kind of institutional use cases, but it will take time because these systems need time to scale.
Okay, I'm so sorry we are running very late. So please feel free to ask panelists individually any other questions. Just to quickly summarize, most of the major banks have their blockchain labs or strategies, but at the same time, by the time public blockchains become scalable, maybe private permissions could be the bridge to that, and that's it. Thank you. Thanks a lot.